Hi everyone, welcome to chapter 3. Very interesting. That tells us about property taxation, and we will discuss about VAT, value added tax, CGT, CDLT, LTT. Load of things we will look at, that is value added tax, capital gain tax, stamp duty, land tax, land transaction tax. So all of it we will cover in this chapter. Of course, it's a bit challenging, but we are here to make it easy for all of you. So let's set the scene. This chapter is all about understanding taxes that affect property transaction, your obligation, available reliefs, and planning strategies. So we are looking at three main taxes: VAT, value added tax on property supplies. This is crucial for commercial property transactions. CGT, capital gain tax on disposals. This hits sellers when they make a profit on property sales. You buy the property, you pay it. You sell it, you pay it. SDLT and LTT, stamp duty, land tax in England and Wales, and stamp duty, that is SDLT, that is in England and Northern Ireland, and land transaction tax in Wales. These are paid by buyers. So here is my tip for tackling property taxation question. Think of the buyer, seller, and HMRC roles at every stage. Who pays? Who benefits? Who owes taxes? Get those relationships clear in your mind and the answers become more obvious. So let's start with VAT, understanding what is VAT, value added tax. So VAT is charged on supply of goods and services in the course of business. It's a consumption tax ultimately paid by the end consumer. There are three categories you need to know exempt. Certain supplies are exempt from VAT, like insurance and finance. No VAT charges, and importantly, you can't recover input VAT on these. Zero rated, things like most food and children's clothes are zero taxed. That means VAT is charged at 0%, but crucially, you can recover input VAT. So zero rated is better than exempt for business. Standard rated, most goods and services are charged at the standard rate of 20%. Simple example, a law firm charges a client £5,000 for conveyancing work. VAT at 20% is £1,000. So the total bill is £6,000. The client pays £6,000. The law firm keeps £5,000 and pays £1,000 to HMRC. Straightforward, right? But it gets more interesting when we look at input and output VAT on our slide here. So input tax, this is VAT that a business pays to its suppliers. For example, our law firm buys computers for £1,000 plus VAT, that is £200. That 200 is input tax. The firm has paid it out. So output tax is VAT that customer pays to the business. When the law firm charges a client 5,000 plus 1,000 VAT, that 1,000 is input tax. The firm has collected it from the client. Now, here is how it works. VAT registered businesses collect output VAT from the customer and pay input VAT to suppliers. But they don't pay both amounts to HMRC. Instead, they offset them. If you have collected £1,000 output VAT and paid £200 input VAT, you only pay the difference, and that is £800 to HMRC. So you get to reclaim that input VAT. This is the whole point of the VAT system, if you are just working in your SQE exam. It's designed so that VAT is only paid once by the final consumer, even though it passes through multiple business-to-business transactions. So I hope you understand it, input and output, and how to calculate it. So let's talk about VAT recovery. So I have made these slides very minimal so you can focus on what I'm trying to explain. So let me give you a clear example of VAT recovery. Imagine a business in a quarter. They have paid £10,000 in input VAT to their suppliers. That's VAT on all the goods and services they have bought for their business over the quarter. They have collected £30,000 in output VAT from their customers. That's VAT charged on their sales. The calculation is simple. Output VAT minus input VAT equals to what you owe to HMRC. That is 30,000 minus 10,000 equals £20,000. So they pay £20,000 to HMRC for the quarter. They have effectively recovered that 10,000 input VAT by offsetting it against the output VAT they collected. This works smoothly for most businesses, but property transaction, that's where it gets a bit complicated. How it works here is the problem. The sale or lease of land and building is generally exempt from VAT. And remember what I said about exempt supplies, you cannot recover input VAT on exempt supplies. Let me show you why this matters with an example. A developer, for example, builds an office block. The construction costs £500,000 plus £100,000 pound VAT, total cost £600,000. They have paid £100,000 VAT to the construction company. Now they sell or lease the office block. Normally, if this were standard rated, they had charged VAT on the sale, recovered that 100,000 input VAT, and everything is fine. But because the sale or lease of commercial property is exempt, they cannot charge VAT on the sale, which means they cannot recover £100,000 input VAT they paid during construction. The result, that £100,000 becomes a real cost. The true cost of their project is £600,000, not £500,000. That's a massive hit to the profit margin. So what's the solution? The option to tax. We got it. So here we go. The option to tax is a mechanism that allows property owner to waive the exemption and instead charge standard rate VAT at 20% on their property transaction. Let's see how this works with the same developer example. They built the office block, construction cost £500,000 plus £100,000 VAT. They have paid out £600,000 total. Before selling, they select to exercise the option to tax on this property. Now they sell the office block for example, 1 million plus £200,000 VAT. Because they have opted to tax, they can charge VAT on the sale. Total sale price is £1,200,000, 1.2 million, like you can say it. Here is the clever bit, you have collected £200,000 output VAT from the buyer. They have paid £100,000 input VAT to the construction company. The offset, £200,000 minus £100,000 equals to £100,000 to HMRC. Their net position, they have recovered that £100,000 construction VAT and received £100,000 net from the sale. Much better than the exempt scenario where they have borne the £100,000 VAT as a real cost. This is why the option to tax is so widely used in commercial properties. So VAT pros and cons. The option to tax is not always perfect. It has advantages and disadvantages. Advantages, you can recover input VAT on construction services. You can offset VAT charges from professional advisor. And if your tenant is VAT registered and making taxable supplies, they can recover the VAT too. So it does not increase their real cost. Disadvantage, the option to VAT is irrecoverable for 20 years. You can't change your mind. It can create tenant issues, and it means higher rents nominally, even if the VAT is recoverable. Of course, market. You need to look at market. Here is where it matters. Imagine you have opted to tax and you are trying to let the property. Tenant A is a VAT registered manufacturer. They pay rent of 60,000 plus 12,000 VAT, total 72,000, but they recover £12,000 VAT. So their real cost is 60,000. They are happy. Tenant B is a bank. Bank provides exempt financial services, so they cannot recover VAT. They pay rent of 60,000 plus 12,000 VAT, and they can't recover that 12,000. Their real cost is £72,000. They are not happy. and they might not rent from you and they move to another building. Okay, the next is VAT and commercial leases. Let's look at specifically at commercial leases because this is common exam scenario. The grant of lease is generally exempt from VAT, but again, the option to VAT may apply. Here is, an example that trips us all. A lease sets the rent at £60,000 per year and is silent on VAT. Before the lease is granted, the landlord exercises the option to tax. What happens? The tenant pays 60,000 total, but here is the key. The 60,000 is now treated as VAT inclusive. The VAT element is £10,000 and the net rent is £50,000. The landlord must account for £10,000 to VAT to HMRC at that point. The tenant does not pay more than the stated £60,000, but the landlord net receipt is reduced because they have, to extract and remit the VAT element. This is why commercial leases need clear VAT provision. If you want the tenant to pay £60,000 net plus VAT, you need to say it in explicit terms in your lease. New commercial property. Here is special rule for that catches us all. New commercial property less than 3 years old is automatically standard rated for VAT purposes. You don't need to elect to opt to tax at that point. It is automatic. For example, your office building is completed in January 2025. It's sold in March 2025 for £2 million. The VAT is 400,000. So and that is charged automatically because the building is less than 3 years old. Total price is 2.4 million. The buyer needs to know this in advance so they can budget for it. If they are VAT registered and making taxable supplies, they can recover 400,000. If not, it's real cost. And this 3-year rule is very frequently tested in SQE exam. Okay, VAT in sale contracts. Let's look at how VAT is treated in standard sale contracts because residential and commercial contract handle this differently. Residential property under standard condition of sale, the purchase price includes any VAT. So if your house is sold for 300,000, that's the total price including any VAT. The buyer does not pay extra. Commercial property under standard commercial property conditions, VAT is payable in addition to purchase price unless there is special condition, specifically special condition A1 saying otherwise at that point. So if a commercial property is sold for 1 million and the seller has opted to tax, the buyer pays 1 million plus 200,000 VAT totaling 1.2 million. This difference between residential and commercial contract is really important. Buyers need clear advice about whether they are paying VAT on the top of stated price or not. So that's what a solicitor needs to keep in mind once they are dealing with property transaction. So that's all about VAT. Let's jump to CGT, capital gain tax. This is a tax on gains from the disposal of chargeable asset, including property. Here is how it works. When you dispose of an asset, you calculate your gain by taking the sale proceeds, deducting the original purchase price and deducting allowable costs. For example, Mrs. Chen, for example, bought a property for 200,000. She sells it years later for 450,000. So her allowable costs, things like legal fee, SDLT, the improvement cost totals 50,000. So her gain calculation, sale price 450,000 minus purchase price, that is 200,000 minus cost 50,000 equals gain of 200,000. So now there is an annual exempt account and currently it is 3,000 per person. This can be deducted from the gain. So Mrs. Chen, taxable gain is £197,000. She shall pay CGT on the £197,000. The rate depends on whatever she is a basic rate or higher rate taxpayer, and where the property is residential or commercial, the residential property rate are 18% of the basic value rate taxpayer and 24% for the higher one. Basic 18 and higher 24%. And that's a substantial tax bill, which is why reliefs are so important to understand. So, deductible costs for CGT purposes. So not all costs are deductible for CGT purposes. You need to know what counts and what does not. Deductible costs include the original purchase price, legal fee on purchase, STLT paid when you bought it, the cost of improvement, things that enhance the property value, and selling costs like estate agent fee and legal fee on sale. Non-deductible repairs, maintenance, decorating, mortgage interest. These are either running cost or financing cost, not capital expenditure that enhance the asset. So what enhances the asset, that is deductible. Otherwise, running cost is not. Some example that we got it like, a new kitchen, that's improvement, deductible. Repairing the boiler, that's maintenance, not deductible. Loft conversion, improvement, deductible. Replacing worn carpet, that's maintenance, not deductible. This distinction is like, does it enhance the property? That's what you need to keep in mind, or it is only a maintenance. Getting this distinction right can make a big difference to the CGT calculation and your exam marks. So we got PPR, private residence relief. Here is the big one. Private residence relief or PPR. This is a complete exemption from CGT for the sale of your main residence. If you buy a house, live in it as your only or main home and then sell it, and again whatsoever the gain that you have made is exempt from CGT, zero tax. Sarah buys a house for 200,000. She lives in it as her main residence for 10 years and sells it for 500,000. Gain is 300,000, zero tax on it. Sarah is lucky. This is increasingly generous, and it is why most people in UK never pay CGT on property sales. As long as it's your main residence, you are protected. Otherwise, of course, you make money, you pay money. Absence and nomination. PPR can still apply even if you are not physically present in the property throughout your ownership. Certain absences are deemed occupation. Temporary absence are fine, holiday, working abroad for your employer, those kind of things, as long as you intend to return to the property and that's your main property. But if you own two properties, you can nominate which one is your main residence for PPR purposes. Example, Tom owns a flat in London and a cottage in Cornwall. He spends time in both. He nominates the London flat as his main residence. Tom is smart. So when he sells the London flat, PPR applies to the gain. When he sells the Cornwall cottage, it is treated as a second home and CGT will apply on Cornwall cottage. So wish Tom all the best. So the next thing is part business use and letting relief. What if you use part of your home exclusively for business, or what if you let out part or all of your property? If part of your property or part of your home is used exclusively for business, like a dedicated home office that clients visit, the portion does not qualify for PPR. You shall pay CGT on the proportion of the gain attributable to the business use. But there is also letting relief. If you let out part of all of your property while you also live in it, like having a lodger, you can claim letting relief of up to £40,000. Example, Emma lives in her flat for 10 years. For 5 of those years, he has a lodger living in one of the rooms, resulting the entire gain qualifies for PPR because she's living there throughout. Plus, she gets letting relief of up to 40,000 to recover any potential restriction from the letting. So letting relief is complex and has been significantly restricted in recent years, but it's still available when there is shared occupation. So just remember, if you let the whole property out while not living there at all, letting relief does not apply. So the next thing is CDLT that we need to understand. Very, very important. This is paid by the buyer on land transaction in England and Northern Ireland. Wales has its own system, which we shall cover in a moment. SDLT is charged on chargeable consideration. That's not just the purchase price. It includes everything that the buyer gives for the property. The purchase price, any VAT, any debt the buyer assumes, deferred payment, anything, everything. So a lease is granted with the premium of 100,000. SDLT is payable based on the full premium. If there is also rent payable, there is additional CDLT on the net present value of the rent. SDLT is paid by the buyer, not the seller. The buyer solicitor must submit the SDLT return to HMRC within 14 days of completion and pay the tax. This is one of those most post-completion duties we talked about in Chapter 1. Failure to pay SDLT on time results in penalties and interest, and it's crucial to get it right. SDLT rates, how it works. SDLT is charged on a sliding scale of rate for residential property. The current rates are 0 on the first 250,000, 5% on the portion from 250,000 to 925,000 pounds, 10% on the portion from 925,000 pounds to 1.5 million, 12% on anything above 1.5 million. I hope it is same today because it changes a lot. So I advise you to keep checking if they change. But there are reliefs. First time buyers get a special relief, 0 up to 425,000 pounds, then 5% from 425,000 pounds to 625,000 pounds. This only applies if the purchase price is 625,000 pounds or less. Above, no first time buyer relief at all. You are already rich, pay the money. So there is also additional property surcharge, 3% on all bands if you are buying a second home on investment property. This is on the top of normal rate, or it significantly increases, oh my goodness, your SDLT bill. Example, first time buyer purchases a home for 500,000. They paid 0% on the first 425,000 pounds, then 5% on 75,000 pounds. That's 3,750 pounds SDLT in total. So you get a home for 500,000, you pay the money. Next is apportioning chattels. So it is clever planning point. SDLT is only payable on land and fixture, not the chattel, movable personal property. Example, a property is being sold for 255,000 pounds, but it includes carpets and curtains worth 5,000. If the contract apportions the price 250,000 for the property and 5,000 for the chattels, the SDLT is only charged on 250,000. Why does this matter? Because SDLT starts at 0 up to 250,000. If you pay 255,000 all the property, you are paying 5% SDLT on 5,000. But if you apportion 5,000 to chattels, 0%. You are not paying anything. You got a smart lawyer. So the next thing is SDLT in Wales. That's what we need to understand. Of course, LTT, we call it, Land Transaction Tax, which replaced SDLT in Wales and is administered by Welsh Revenue Authority. The structure is similar to SDLT, but the rates and bands are different. For residential property in Wales, 0 on the first 225,000, but 6%, 7.5%, 10% and 12% on higher bands, as we have talked about. Importantly, there is no first-time buyer relief in Wales, so first-time buyer in Wales pay the standard rate, unlike in England, where they get preferential treatment. Example, a buyer purchases a property in Wales for 300,000. They pay 0% on the first 225,000 pounds, then 6% on the next 75,000. That's 405,000 pounds LTT. Compare that to England, where it would be 0% on 250,000 pounds, then 5% on 50,000 equals 205,000 SDLT. The Welsh system generally results in higher tax at mid-range prices. I hope it works, like you understand how VAT works, how capital gain tax works, and how stamp duty works, and how they are calculated. And I wish you all the very best in understanding it. We have tried to make it easy. If you like it, hit the subscribe button and share it with your friends. I wish you all the best. Take care. Ta-da.